To remain updated with the latest business news, click on the bell icon.
Welcoming Anshu Malik, MD and CEO, as well as Shrikant Kanhere, CFO, Adani Wilmar, with us here on Business Today to discuss the upcoming issue of Adani Wilmar. It's a much talked about issue, one of the biggest players in the food segment, the branded food segment, and they have a lot of exciting plans going ahead. So let's come to you first, Mr. Malik, in terms of what led you to approach the capital markets, the kind of opportunity and scale that you're looking at when it comes to this segment.
See, for the last 22 years, Adani Wilmar, a 50-50 joint venture between Adani Group of India and Wilmar of Singapore. We forayed into edible oil, and slowly in a short span of 10 years, we became the market leader. Across the country, we established the brand Fortune distribution network and factories across both the hinterland so that we can buy the local crops such as mustard, soybean, cottonseed oil, rice bran, and then the ports where we can import the imported oil. Now, over the years, we have developed a very big infrastructure. Today, we have more than 50 factories, 22 our own, 28 we do tooling. We have 90 warehouses across the country and more than 5,500 distributors, reaching to around 1.8 or 18 lakh retail outlets. Now, that is what is the coverage of the brand Fortune and other brands under umbrella of Adani Wilmar. We have seen that every household needs daily essentials such as roti, chapati, or atta. Then they need maida, they need suji, rava. They are requiring dal, besan, then rice, sugar. So these are the essentials that everybody wants. But you will see that the way edible oil has become branded, and today 80% of the edible oil is branded and sold even in the smaller towns and rural markets. The same is not true for wheat flour or rice or dal and all that. Still today, almost 90% is still loose and unbranded, unhygienically sold and packed. So consumers are shifting from loose to packed and unbranded to branded, and we would like to provide the best quality products at the most competitive price at the destination that they stay, using our strength of distribution that we have developed in the last 20 years, our brand Fortune, our supply chain, our knowledge of the local market and international market, all put together. We want to give this to the consumers of the country. Now, when we want to do it, surely you need investments in infrastructure. You need investment to bring in the technology, the best technology of the globe to India, so that India consumers get the same quality of wheat flour or rice or dal or value-added products from here onwards. Because if the base products are good, then obviously the value-added product out of this, whether you make noodles or you make pasta or even simple bun or bread, that quality will be even better. So all these things put together needs capital investments, and we are going ahead with that. That is one of the things. And we had debts of around 1,100 crores on our books, which we want to pay. This entire issue IPO is primary, and 3,600 crores will go only in investments of growth. There is some money kept for acquisitions, because as we go along, we will have a lot of opportunities to acquire local brands, regional brands. We can be a strategic investor in many of the companies which are in the food arena.
Okay, so lots of exciting plans there. Shrikant, let's talk about the size of the issue. You have reduced it from what was initially listed in the prospectus. It says for general corporate purposes. Pricing is fairly aggressive. The kind of valuation that the company is looking at here.
We filed our DRHP in August with the issue size up to 4,500 crore, and as per the regulatory guidelines, a issuer can actually increase or reduce the size of the issue by 20%, and that's what we did. So we have reduced the size from 4,500 to 3,600 by taking out the general corporate purpose and making it more directed towards a core objects of the issue, which is more to do with the capex, repayment of a term loan, and mergers and acquisition. This also makes more effectiveness as far as the capital structure is concerned, and it will help us, to maintain the kind of return matrix we have been able to showcase till now. The issue is, as Mr. Malik said, is a full primary issue. Will be a 12% of overall capital post issuance. It is priced at 230 at a top band, and 218 at a lower band. It's a very aggressive pricing which we have put in for the investors, and we are quite hopeful that it will be received very well by every category of investors who really want to invest in a company which has got one of the fastest growing and one of the best brand in the country, and the best distribution and manufacturing setup, and a company which is one of the fastest growing food FMCG company of India.
Mr. Malik, give us a little bit more of a sense of the kind of growth you've consistently seen over the last few years to give investors an idea of what's in store. You already, of course, have a big brand fortune when it comes to edible oils, and you mentioned you're also looking at growing several other brands in the food category. But give us a sense of, since you're not allowed to make forward-looking statements at the moment, but the kind of pace of growth that you've already seen in Adani Wilmar, so that investors also get an insight into what's in store.
See, when you look at edible oil, we are at around 18.3% market share today, and it's growing consistently. So we expect to continue with this growth. Edible oil as a category is matured category, so it's growing at around 5%, 6% per annum. We are growing a little higher than that, and we hope to continue with that same growth. But when you look at 5%, 6%, we are looking at a volume of 2.5 million to 3 million metric tons. So one has to look at the total overall size. Now, when it comes to food, the food business country is comparatively much smaller in terms of branded and packed. And COVID has actually accelerated this branding and packed commodity purchase. People sitting at home wanted to order their rice or dal or wheat flour. And obviously, anybody would like to go for a brand which they have at least heard of, if not used. So we have seen a lot of traction. And today, branded grocery in e-commerce is around 15%. So if 100 tons is sold in the country, 15 tons come from the e-commerce. So that is the type of business that e-commerce is doing and growing at around more than 50%. And we are doing reasonably well there. Company has been growing at around 25-30% in the past in food, branded food staples. And we hope to continue with the same speed. Although the growth rate of the country is smaller, but as a company, Adani Wilmar has been pushing aggressively. And so we have been growing at around 25-30%, which I hope we will continue.
Margins, Shrikant, with the e-commerce play, are we seeing even further improved margins, or are raw material prices playing spoil sport? Are you keeping things competitive? What's the direction you're looking at when it comes to margins?
Yeah, I agree. The competition has to be there, and that makes the whole equation very well set for any player like Adani Wilmar, who is one of the fastest growing food FMCG company in India today. See, the margin consolidation, which typically any company looks at, usually comes from two things. One is, of course, how are you able to consolidate your market share, right? And that helps you a premiumization, which will sink in your sales realization, and that's how you improve your margin. And then, of course, second is, how are you able to manage the costs? And given the fact that Adani Wilmar is one of the biggest now, and we handle more than 4.5 million tons of volume with a good integrated plants in place, we have a very good plan in place that how can I optimize my costs, how can I consolidate my market share, and therefore not only from the sales realization improvement, but also from the cost, how I am able to consolidate my margins, number one. Number two, and as Mr. Malik said, the whole focus of the company in next 5 years is going to be the food, and food gives you a better margins, of course, because it goes into a smaller SKUs. The smaller the SKU, higher the margins. We are hopeful that this strategy will work. Our food portfolio will go to the next level, and we are very optimistic that it will also start reflecting in the margin profile of the company as we move forward.
Okay, and you mentioned acquisitions, Mr. Malik. Talk to us about, possibly where you would look when you're mentioning regional players or the kind of segments perhaps you'd look at, brands that you could once again take international as well?
See, most of the acquisitions are possible in the food area where they are a brand, good brand, but scale up can be done because we are a national player. So our objective would always be to look at a smaller regional good brand where we can add our value, because whatever has happened to that brand so far, the owner has done a good job. But to scale it up, to take it to the next level, to take it to the international market, that is what we can do better. So we would like to do it. So we would look at brands which are strong locally, regionally. They have a product fit, they have a distribution fit, they have manufacturing fit. Second, acquisitions can also be strategic investments. Not that we only have to do everything. There are people who are experts in their job. They may require only some support from us. So we would be a strategic investor and we would let them do, and we help them in exporting or something, because we have very good export market. Wilmar, you know, it operates in 90 countries, and in every country they have a company like Adani Wilmar, where they do joint venture and they do distribution. So you can actually go and distribute your products in many countries. So that is what we do, and that is what we can do. So acquisition will be on all these things.
And we must ask you on the budget and what your expectations are this time around from the finance minister.
The duty has been reduced and cut. Actually, there is now no duty except 5% that market fee or something. That otherwise there is no duty, so nothing much can be expected. Third, government has been pushing, promoting local oilseed production and all that. So we are part of it, and we would also like to happen, because as edible oil leading player, we would like to also depend more and more on our own country for our supply chain. That is good, and that is also important for us to be there. We are looking at what kind of support the budget will bring on agriculture in terms of better infrastructure, if you put any kind of subsidies or any kind of collaborations which can be done, because we have large plans of investment in agribusiness. So obviously we will look forward to any kind of such type of benefits being given to investments in agribusiness.
If you like the video, do like, comment, share and subscribe.